in the middle here, Frank said, why not 7 days to expiration and 14 days to expiration? Why so long? I put in a range. Actually, I should have put in 15, knowing that only the 7s would come up. Okay? But see, if I run this search on Monday, I'd still get the standard Friday expiration. If I run it on Wednesday, I'll still get the standard Friday expiration. But if I'm running it next Thursday, I probably won't see the Friday 1 day away. I'd want to see next week. So this allows me to see both. Now, if I went 2 to 15, we're going to get more results. Okay? Yeah, so now we're seeing the 14 days, and there. So that range I put in was to allow a stretch of days, Frank, that regardless of what I'm searching, I'm going to see the one, but once I hit Wednesday or Thursday, I don't want to see that Friday anymore. I want to see the week out, which is 8, 9, 10 days out. Okay, so I'm allowing for that time frame. Now I went to 15 to show you that as I'm running it on Friday, what this allowed me to do is see the near week and the following week as well. This leads us to another interesting topic. In a sense, it's not a question that came in, but whenever I do weeklies, Frank, for example, on certain strategies, we'll leave the diagonal spreads for the moment, and we'll come back here. I go to bull put credit spreads, and I go to search. And as we saw before with the calendar spread, it's going to pull up a list of potential trades that match our default screen. But this is interesting, isn't it, Frank? It says weekly bull put credit spreads, but all of the puts are 14 days out in time. Why? And my days to expiration are 8 to 17 days out in time. Why? Well, it's sort of talked about here a little bit. We want to use the options expiring 2 weeks out in time rather than 1 week, and because we're looking for a minimum net credit of 20 cents. It's very hard to find good probability credit spreads 5 or 4 days out in time unless you go 3, 4, 5, 6 points apart, or usually 5 points apart or more, to get the 20-cent net credit. Most of mine are going to be 2 to 2.5. Some will be 5. This one's a 2. There's a 5 there on Splunk. Okay. And now to the meat of it. Why am I calling a spread search? This is the one I created. We'll talk about what Ernie did for the covered calls and the naked puts. Why is this weekly bull put spread called a weekly bull put if it's looking 2 weeks out in time? And that's because over years of trading this and testing, the last 4 years or so, really delving into all possible scenarios of the bull put credit spreads, testing 1 strike apart or less spreads only, 2 strikes apart spreads lesser only, anything 5-point spreads only, or anything 2.5 points or higher, anything 2 points or higher, anything 50-cent spreads. Probability. What about 1-point spreads with 70% probability? What about 1-point spreads with 75% probability? Run that consistently, paper trade it, actually trade it, and then test it over multiple markets. What I found long-term for a full testing year of 2014, 2015, 2016, most of my trading from 2015, 2016, 17, other tests done in 2018 and 19, is that the return long-term, factoring in that you will take losers, especially if you think about 2018, right? 6 of the 12 months in 2018 were negative market performance. But where I'm going with this is that factoring in all the gains and losses over a time horizon, assuming no management, just the best success rate, we found that the 2-week out spreads perform better than the 1-week out spreads, believe it or not. The main reason why is that if I took the results of this search here over a certain time frame, I don't have all my pages with me now and all my notes open with what the numbers were for 2017, 2016, 2018, and so forth. I have it somewhere. I just don't have it right now. I'll try to get that later. But look, doing both with an 85% probability, looking for a minimum 9% return on the position, which even if I lowered that for the 1 week out to 5% and lowered this down to 10 cents, I typically average around an 83-84% success rate, and I have a plan to close my losers on the bull puts at a certain point when there's a market switchover like we saw at the end of February, like we saw at February 5th through 8th of 2018, that first little volatility VIX spike up because I believe it was a discussion with trade war in China way back then, 2 years ago, 2 years and 3 months ago. But in any case, what happens is if I'm collecting 30, 40, 50 cents on a 2-point spread, okay? That's about the average, 30 or 40 cents, okay? And when the means I'm risking 170, okay? So when the stock collapses and I lose 50% of this, or 85 cents, I'm going to try to close it for a 50% loss of the maximum loss, so I get closed at 85 cents. I've only wiped out 3 previous trades. I do a weekly with a 1-point spread, which is probably only going to give me 10 cents. With that 85% probability, it might only be 7 cents. So I'm 7 cents to 93. That's a terrible 7. Sorry. 7 cents to 93 risk on a 1-point spread. Or on a 2-point spread, I'm looking to make maybe 11 cents. Now, it'd probably be higher. It'd probably be 16 cents, let's call it, because it'd be more than that. It does work. This is always less than 2 weeks out is less than double the 1 week out. But if I'm making 16 cents on a 2-point spread and I lose $1 here on this position, how many previous trades is that wiped out? It's not 3, right? It's about 6. It's about 6 there. It's about 5 or 6. I'm sorry, 6, yeah. So I wiped out 6 previous trades, double the amount of trades. And you still have those days. You can't control that. Those days still happen and will take out the 4 or 5 trades you have open on the weekly cycle, wiping out, even if you're closing at a 50% loss, you're wiping out 6 more trades. Okay, so each of those 4 you have open, you've wiped out 24 previous trades. The 3 or 4 I've had open here, I'm wiping out maybe 8 or 9 previous trades, maybe 10. And these events happen, and they can't be controlled, and stop orders don't help control it. You just have to close it out before that loss gets above 50%, and you're wiping out more because of the smaller net credit. So same time horizon, same probability, shortening the spread didn't mean necessarily more profits. It didn't mean a higher success rate, because when you do take the loss, which you took in both portfolios, the losses with the smaller net credit that wiped out more trades sets you back faster in that case. And that's just what we saw over multiple markets and multiple years of actual trades and testing positions and trading real 2-week out positions there, and then also comparing it side by side with paper trades on the same stock of 1 week out positions or 1 strike apart positions. So long story short, probably did about 65, 70, maybe 75 iterations of criteria over these multiple markets to see what worked best. And every time I ran the test, going 85% out, 85% probability, 2 weeks out in time, looking for a spread, a strike difference of $2 or greater, minimum 9% return with some of these other technical indicators, that always performed best for me when comparing and analyzing. This is a similar approach to what Ernie did with the covered calls and the naked puts. You see here we have these extra tools in addition to the search. We've got the monthly picks of the day and the weekly picks of the day for covered calls and naked puts. Of course, what these are is very similar to what I just described, but what Ernie did is he went back and he did a whole series of tests with different criteria: in the money, out of the money, at the money covered calls, weekly, and he did monthly as well. Is it better to look for higher implied volatility or lower implied volatility? Is it better to avoid earnings or not avoid earnings? Okay, is it better to look for a specific uptrend, a specific Bollinger Band, a specific delta, anything of those lines? Hundreds of different variations to test which criteria perform best over those time frames. And that's what these picks of the day are. This is just a quick view that shows you the top 3 results that would have matched from the search at 1 o'clock this afternoon. And Ernie goes through, he's got links here to see how he found these selections, the results of 1 year of historical testing and screening criteria, and what his process was for going through that. And you can just click those links and you can read about it all there, okay? All right, so that's how multiple tests with the historical tools and more to see which criteria perform best over time. And yes, you can see the ones that are updated in the afternoon here for the weekly picks of the day for covered call and naked puts. But if you still go into the covered call search by itself or the naked put search, I'll wait for the screen, there we go, you see that you can get the updated list and see the criteria that was used that Ernie mentioned in that write-up right here for what he found to be the best performing over time, looking at a weekly or a monthly covered call. Now, we probably haven't visited that in a year or so, in several months, I should say, maybe not a year, but several months, to see if any tweaking is necessary. But it did work over multiple markets. William asked, Mike, to clarify, when you sell to open a 2-week out credit spread, that's $2 wide, do you say that you typically receive a 30 to 40 cent credit and look to keep about 16 of that? No, okay. I'm sorry if you misunderstood that. All right, let's go back. There's a couple of thoughts here I didn't really get deep into, William, for the sake of time. What I was saying is, you see you've got 25 cents here, 33 cents. The top four are 39, 35, and 30. Okay, the top three that match the criteria. This is the list I would choose from. It's about 20% return on the position. Now, this is a question that came up earlier. It comes up this way. Now, he said, William says, and look to keep about 16% of that, netting about 9%. Is that correct? No. When I enter a bull put credit spread, and I'm sorry if my comments were misleading, if I was going too fast there, if I misspoke. When I enter these bull put credits, my goal is to make the maximum profit. I am not planning on closing early. I never close a bull put credit spread early unless it goes against me. Okay? I am going to hold this as close to expiration as possible to get the full 39 cents, 35 cents, get close to the maximum return on the position. If the stock if the stock really took off in the first 5 or 6 days, and I could liquidate this position for only a 17-cent debit, meaning I'm keeping 50% of what I invested, I am not doing that. I am going for the full profit on the position. Okay? What I was saying is that in comparison, try to give a breakdown between the tests without the papers that I have right here. Here's my 2-week out spread. Let's stick with the easy one. Skyworks Solutions, 117, selling the 5th of June, 107, buying the 5th of June, 105, getting a 30-cent net credit with about an 86% probability the stock will be above 107 in the next 14 days. Okay, so now what I was saying is that if I went to, this is my 2-week out, William, that 16 cents I was referring to is that if I went down to the 29th, if I looked for a spread to open that was 1 week out on Skyworks that had an 85, 86% probability, I'm probably only taking in 16 cents, but still risking the same maybe $2 spread. Okay, so that means that I took in less, and if the market does go down next week, I'm wiping out more trades with that weekly series than I was with the 2-week out because I was able to get a higher net credit. It's not double. The 2-week out is not double the 1 week out net credit. I'm not saying that. I'm saying that getting the higher net credit cushions the blow if and when there is a decline. So this has nothing to do. My plan is to hold this all the way to expiration and get as much of that profit as possible. I never close a credit spread when I hit a 50% profit of the credit I received. Okay? Why? And we had this discussion before a couple weeks ago, and the gentleman over at tastywork/tastytrade talk about closing a spread when you hit a 50% profit. They're not talking about deep out of the money, high probability credit spreads. What they're talking about is sort of at the money or slightly out of the money debit spreads where you're looking at a 1-to-1 risk-reward ratio. meaning on Skyworks here at 117, if I entered a bull call debit spread by selling the 120 and buying the 115, I'm only paying maybe a debit of 210 or 250. So if the stock goes up to 120 and I get the full 5 points back, I've had a 1-to-1 risk-reward ratio. I profit 250 on risking 250. And they're saying that if you get to a point where you can close that out at $1.25, take it because you're still making a 50% profit on the position. They're not referring to this. And let me explain why. I'm going to go, well, first, let's just verify. I'm going to go to our spread chain tool very quickly. Midpoint spread chain, excuse me. And they're here. I'm looking for 2-point spreads, minimum 15-cent net credit fine. We're going to have to lower that. And, I got to have my probability range up to 84, 85% to 94. Okay. So my spread's still there. It's highlighted in red for us. This is our bull put with the 105, 107 strike. For 14 days out. Let me bring it in a week. Okay. The 105, 107 isn't there because for 1 week out, that's a probability of 90%, and you're only looking at maybe a 5 or 6 cent credit. Okay, so I'd have to lower it. But look, this is another thing that changes when you go closer in, when you go to the 1 week out, which I was talking about this whole conversation we started for Frank, saying, why are you going 2 to 14 days out? Why aren't you looking for less than 7? And this was borne out by the testing of the bull put credit spread. The position we just analyzed, we looked at, was a 2 week out 105, 107 for an 17.6% return at a 30-cent midpoint net credit. What are the 85 and 88% probabilities 1 week closer in? Exactly what I said they would be. 15, 16, 17 cents. More than half. Okay, or more than half of this out here. It's not double, but exactly in the range that we thought it would be. What else is different? You're not at 105. You're not 8% out of the money. You're at the 110, 108, or the 109, 107 because you have to be closer to the current stock price when you go 1 week out to get the reasonable credit and the reasonable return that you'd want. This is a much higher annualized return, but remember, if I only get 16 cents on this 2-point spread and the stock falls to 108 next week, this spread is at 100% loss. My position is still out of the money. Okay, the 105, 107 for 2 weeks out is still out of the money in that case. All right, so this is what we saw testing. Now, that's just to prove my point that I'm not just pulling numbers out of a hat here. This is what we typically see historically over time. Same probabilities, but you got to be closer to at the money naturally when you're comparing 1 week out versus 2 weeks out. But because you're getting a lower net credit, if when you do take a loss, you wipe out more of your previous gains in that position. And you have a chance of taking a higher loss because you're closer to the current stock price. To the other point, let's go over to radioactive trading. And I am going to use the resources tab on radioactive trading. We are going to go to what's called the trade simulator tool. And the trade simulator tool allows me to put in values of an expected target win. So I'm planning a spread position, okay? A portfolio. I'm trying to see the numbers that I'd want. And we saw positions on the last screen that were showing a 17, 18, and 20% return. But let's say that my average return for my leverage spreads is 14.9%. And when I take a loss, I'm going to take a loss of about 50%. The stock suddenly falls. I was risking $2. I'm going to try to close it out for only a $1 loss. I'm going to try to keep it at 50%. Okay, but the probability of loss is what? It's 15%. I'm looking for 85% probabilities. Now, if I have $10,000 to trade, we might, let's say $10,000 of my total account allocated. It should only be 10 or 15% of your total account allocated to these types of spreads. But let's break this to 25%. So I'm going to open, technically that means if I took $10,000, I'd allocate $2,500 to 4 different bull put credit spreads from my search. Okay, now, We start out with $10,000. Oh, I'm sorry. Oh, sorry about that, folks. Let me put this back here. Okay, get out of the box. There we go. So if I have an 82% success rate, over time, that might be an 80% return after 100 trades, right? Okay, I'm just using this as a base point, but let's say we are right that 83, 84% of the time, 84% of the time. Okay, we might triple over time after 100 trades with this win-loss ratio, triple the initial investing amount started with an ending amount, taking in randomness, win one, win two, lose on our third trade, win one, strings of winners and losers, sometimes two losses back to back. And there's our max drawdown of 14% in this case. But $10,000 might go up to $25,500 roughly, okay, over time. This is the trading plan I'm looking for. This is pretty much close to my average return on the bull put credit spreads over the last few years. I think it's actually higher than this now, but that's inflated recently with implied volatility. I started trading them again end of March, beginning of April. Okay, but in any case, not too much off. And the success rate is usually about 84, 83%, okay? And that's what I'm looking to accomplish. And you've got to control this, which is hard. Sometimes you can't. Sometimes you take a little bit more than a 50% loss, but it's better to get out then rather than hope it comes back and end up seeing a full loss where you have wiped out 10 or 12 previous trades. Okay. But going back to that other point, let's call it 15. What happens if I close out all my winners at 7.5%, meaning that when I saw that 50% profit, that I close out the winners at that price? Now, the theory is to close the spread early is that you increase the amount of winners. With the deep, out-of-the-money, high-probability credit spreads, that's not the case. The ones you lose on, you're still going to lose because you lose when there's a sudden, unexpected decline or a market shift. It doesn't matter if you're looking for a 15% return or a 7.5% return. Those ones typically you lose 50% on, you never see the 7.5% gain, let alone the 15% gain that I was looking for. So you still lose on the same number, and you're cutting your gains in half. And with that same 83, 84% success rate, you cut your money in half. You cut your starting in half, and that makes a lot of sense, doesn't it? The probabilities, the target ranges I mentioned, that 9, but averaging, on the higher end, that 14, 15, 16% gain, you need to be right 83, 84% of the time to hit your target goals. And you could actually hit it at about 78 or 80. But if I cut this in half, I need to be right almost 93% of the time in order to profit long term. And remember, those positions that you close out at 7.5% are the ones that were going your range, and you would have won 15% on likely anyway. The ones that you lost 50% on when that market turned, you never saw that 50% gain. So that's handicapping yourself. I don't close out early on the out-of-the-money bull put credit spreads unless it's somewhere near an 85 or 90% of that original 30 cents I expected to make for some other movement. Okay, so that's just a little bit of the discussion there on why when someone says that they usually close their spreads at a 50% gain, they're talking about those lower risk reward, lower probability debit spreads. You close those at 50% of profit, not the deep, out-of-the-money, high probability credit spreads, because the goal is to get as much of this net credit as possible to still meet your targets. Okay? Okay, so, oh, sorry, William, there's another follow-up here. It said, oh, okay, so gotcha, thanks for the clarification. Thanks for clarification. If the trade goes against you, what percentage loss are you willing to take to avoid? Oh, okay, that's, my target's 50%. Now, if there's a sudden fear, William, okay, if there's a sudden fear, I see the market drop and my spread goes to 30% loss of of the maximum loss, okay, 30 or 35%, and I fear more downside is coming, I might close it then. But in reality, what my target is when I hit that, sort of 45, 50% loss, I usually just exit it. Now, there are ways to manage the positions. We teach those too. There's a free webinar on 8 ways to manage your positions. Just wanted to remind everyone, of course, that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. I'm not saying go do a bull put credit spread on Skyworks, nor open a covered call on Skyworks, nor open a Marriott put on Autodesk. I'm saying these are the structures that I would choose to use based on the criteria selection and the education that we offer. Options to involve risk may not be suitable for all investors. Saw a lot of the tools today. We did a lot on the search. We saw that great discussion with Jim on setting up the ratios for a diagonal calendar call search. And we looked at the married put search as well. We looked at the weekly picks of the day. But if you haven't done so yet and you need a powerful search tool for your options along with the research and analysis and more, even portfolio tools to help you track your positions, just go to poweropt.com, put in your name and email address, and click Start My Trial. You will get a full 14-day free trial. No credit card or billing information is required, just name and email address. And after that, the monthly subscription fees start at $40 a month for the end-of-day data, but we also do offer a low-cost, it's only $65 per month for delayed data, 15-minute delayed data, and of course we do offer real-time service as well and other levels of subscription. We mentioned the webinars page briefly, and I sent you the link to the trade simulator tool at radioactivetrading.com. But of course, you can always check out the webinars page. It's poweropt.com/webinars.asp. We'll try to get these videos clipped up and posted to you by the start of the week, sometime over the weekend. You can always check out our YouTube channel as well. Just go to YouTube, look up Power Options, and our blog, blog.poweropt.com. Okay? All right. If you have any questions at any time, send us an email to support@poweropt.com or support@radioactivetrading.com. You can also call the office during market hours at 302-992-7971. Remember, even if you are just on a trial, even though you're not paying us anything, or you are a subscriber to Power Options, thank you very much, you can schedule a coaching session at any time. It's essentially a 35 to 45-minute coaching session, phone call conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have as well. All right, before we sign off very quickly here, one last question here. Sorry, Frank, give me 1 second. I'm in the wrong view. There we go. All right, so Frank says, I purchased your Naked Puts book years ago. I have one sitting above me right on the desk right now, as a matter of fact. And he says, I'm sorry, it says there's a covered call book, but I can't find it. Okay, so you go into the store, you'll see that there's a subscription, there's the blueprint. This is the covered call course. Covered Call's Aggressive Strategy for the Conservative Investor. This is all online now. So that if you purchase the Covered Calls course, we'll send you to an educational website. It's learn.poweropt.com, and you'll be able to access all of the information and the videos there on the Covered Call course directly from that website. It's not on Power Options. It's on our website, our educational website, learn.poweropt.com. And that's how the blueprint is now delivered as well, immediate e-delivery, as well as some of our other educational products, and more will be coming out very soon. Okay, Frank, so you can just go to the products page, the Power Store page, pick that up, take a look at it, and that'll give you access there to that, okay? All right. Well, everyone, take care. Have a fantastic weekend. Fantastic extended weekend. Remember, markets are closed on Monday, so we'll all be back in the seats here on Tuesday. And we'll, of course, see you later on next week, and I'll try to get as many of these segments cropped up and sent out to you going forward. Okay? So take care, everyone. Have a nice, relaxing weekend. Stay safe, and we'll see you soon. Good night.